So, Abhishek, really good to be speaking with you, and thank you for your time. I guess there's a bit of a summary agenda to start with. Obviously, this is a very hot topic in the global economy at the moment. So we've seen 4 rate rises in the UK, the Fed are raising rates, we're expecting rate rises in the EU. We've got major global inflationary pressures, and we're having this conversation with clients on a daily basis around interest rates, and that's everything from traditional vanilla residential mortgages all the way through to structured corporate debt. So I'm really pleased to be having this conversation with you today to talk generally around some of the key points of consideration for what businesses in particular can do to mitigate, or certainly think about mitigating, expected further increases in the cost of borrowing. So I guess before we kind of get into the detail and talk this through, it would be great for those individuals who are listening or watching the video to understand a little bit more about who you are, some of your past experiences, and what your business does.
Great. Okay. Thank you, Scott, for having us on here. So we run Vedanta Hedging Limited, and Vedanta is a independent FCA regulated consultancy advising different types of businesses and also sort of larger PLCs on how to hedge their risk. Now, for today's purposes, that's interest rate risk we're talking about.
Mhm.
So we've been going for about 10 or 11 years now. We've got a whole range of different clients, from tiny SMEs who borrow £500,000 for some buy-to-lets, right up to PLCs and REITs and local governments and authorities,
Mhm.
and private equity funds and infrastructure funds. How we set up was, I mean, I'm an economist by background. I worked in Her Majesty's Treasury. I then worked at Lloyds Bank for about 10 years. And when I was there, I realized through speaking to a lot of mid-cap corporates that they were hanging off my every word when I was talking to them about hedging. And I thought, well, okay, good looks and charm can explain part of that, but actually, why else are they doing that? It's because they had no one else to speak to. Now, lots of people have got good quality debt advisors and brokers to speak to, like yourselves. They've got accountants, they've got solicitors. But when it comes to hedging, they either just don't take any advice at all, or they just listen to what the bank tells them to do.
Mhm.
The bank is the one providing the kind of hedging product or the fixed rate. So how can you expect them to be giving you independent advice?
Yes.
And you wouldn't do that in any other walks of life, right? You
Mhm.
wouldn't walk into an HSBC branch and say, "Oh, please, can you give me your best ever loan today?" and leave it at that. No, you'd hire someone like you to go and source the market for them.
Mhm.
Same way, if you're buying a property, you don't just trust what the seller says it's worth. What do? You get an independent valuation. So we're just providing that kind of services for corporates.
Great. Fantastic. Really, really powerful and certainly needed. And you touched on the point there around, the independent nature, and you just have to look at the level of inquiries that NS as a group receive for that very reason. So that's brilliant. So I guess if we start with kind of a fairly basic question and point, what is interest rate hedging?
Yeah, so interest rate hedging in its simplest form is just protecting yourself against interest rates rising. In the same way that a lot of us are familiar with interest rate hedging in another format, which is when we're getting a mortgage. When you get your first mortgage, you're thinking about, do I go for a fixed rate or a variable rate or a tracker or a couple of things in between? How do you decide that? You're thinking about as an individual, it's the largest purchase I'm making. Do I want to completely fix my outgoings every month? Because I know my biggest incoming, my salary, for example. Or do I want to just have the risk of having floating rates? And there's no easy answer for either. And in the same way, we apply that same level of thinking and decision making to businesses. Businesses have borrowing for all sorts of different reasons, whether it's for property debt, whether you're a developer, hotelier, care homeowner, or whether you're a trading business, and you still have debt for your receivables, for example. So it's about putting potential insurance against interest rate rises on that cost of borrowing that you have.
Sure, sure. And I remember from, certainly my banking days, and it's still a point that comes up in conversation from certain clients is, well, can I not just get a standard fixed rate on my debt from the bank or the borrower? What
Yeah,
do you do on that side?
yeah. So this actually, it can be quite a complicated topic. So a lot of people think that because they're used to fixed rates from their mortgage, because
Mm.
typically you're going to get a property mortgage before you go and get a business mortgage at some point. People think that they can just get the same kind of mortgage or fixed rate, but with business debt, it works very differently, I'm afraid. So with individuals who take out a fixed rate on their mortgage, um, if they take a fixed rate, then there is a known defined penalty cost or redemption cost to get out of it. You can just look at page 13 of the agreement and it will say 1% charge, 2% charge, whatever it may be. It's known, it's there, you decide. With businesses, banks don't really provide that kind of fixed rate product. So even if the bank says yes, it's a fixed rate loan, it might make you think actually it's the same way like a mortgage works, but it doesn't. It's often provided by something called swap rates underpinning that, which basically, in really simple terms, means that when you want to cancel it, if you want to cancel it early, the bank has to go to the market, look at what the prevailing swap or hedging rates are, and charge you accordingly. And those numbers, those purely depend upon what those swap rates are at that time. Could be higher, could be lower, and that's the cost that you'd have to pay as a result.
Sure. Fantastic. Yeah. And what if the debt provider or the bank doesn't provide hedging options, for example? What
Well,
options are available for clients?
Absolutely, Scott. So you look, good trusted debt advisors like yourselves have got access to so many different lenders out there, weird and wonderful names that most people haven't even heard of. And some of these institutions can't provide hedging or choose not to provide hedging. So banks like Oak North, et cetera, or small development banks or foreign banks, et cetera, may choose just not to provide hedging. And you can get your debt from one of these lenders, and you can actually go and buy hedging from a third party bank. We call it independent hedging. So, in the same way, if you're looking to buy an Audi, you go into an Audi showroom and you buy the Audi, you don't think, oh, I have to go and buy insurance from Audi. Yeah, they'll offer it to you, fine. Or they may not offer it to you, doesn't matter. But you can just go away online, you go to confused.com or whatever, or you go to your broker and say, go and find me an insurance policy. So you have your debt with a bank or a series of banks or a bridging lender, whoever it is that that NS has, for example, sourced for you. And you can go out and just get a third party insurance product. It's called a cap typically, which then protects that level of debt that you choose.
Okay. And what sort of debt can be protected? So, we deal with a range of clients, and particularly on the structured corporate debt side, who will have multiple different facilities, sometimes with different providers. So, what sort of debt can be protected under a hedging product?
Yeah, that's a very good question. So, in a sense, pretty much any kind of debt that is exposed to floating rates. What I mean by that is variable rates. So, in other words, if there is a loan which says the rate payable is a margin, call it 2%, 3%, plus base rate or plus SONIA, then we can try and obtain hedging for it. It can be development debt, could be mezzanine debt, it's typically senior debt, can be overdrafts, whatever it may be, revolving debt facilities, whatever they are, even floating rate bonds. As long as it's floating rate, it's something plus base or SONIA,
Yes.
we can basically go and get some hedging to effectively replace that base or SONIA element.
Got you. Got you. And what does that sort of product look like in terms of from a cost perspective?
Yeah. Firstly, if you're doing it from an independent perspective, the minimum size you're looking at realistically needs to be sort of between £3 to £5 million sterling.
Okay.
Because above that, it's difficult to source these independent caps.
Sure.
Just to give your listeners an idea of what it costs at the moment. So a 5-year cap for £5 million at a strike rate, which means the level at which the cap, the kind of policy kicks in, is 2.5 at 2.5%.
Okay.
Costs about £150,000.
Okay.
So to explain that again in simple terms, the customer would have to pay an upfront cash premium of £150,000 to a third-party provider. And then what that means is they have an insurance policy for £5 million for 5 years, which says that if interest rates ever go above 2.5%, they carry on paying those high levels of interest to the lender, but they'll be getting a separate refund every quarter, every month to keep them at that 2.5% cap level. And the beauty of that product also is that if interest rates don't ever go above 2.5%, or if they want to cancel early or redeem it early or anything like that, then that's okay. There's no penalty for them, even if interest rates go down or say that there is an escalation of the Ukraine war or anything happens, if
Yes.
interest rates start falling or whatever it may happen, there's no implication because once you've paid your 150 grand up front on day one, there's no potential liability on you.
Got you. Fantastic. And in terms of, I guess what would be useful for people watching this is the process of what that looks like to go, away from potentially a bank to provide this facility. What does that look like on an end-to-end basis and
Yeah.
timescales and so on?
So just taking a slight step back first. So there's kind of in both types of hedging that we do. So we probably do about 50% of either. So
Mhm.
50% of what we're doing is still helping clients with their existing lenders, right?
Yes.
And that's your NatWest, your Lloyds, your HSBC, and your Barclays. Okay,
Mhm.
and that's where and if you've got debt with at least one of those banks, it makes sense to do hedging with them, albeit take some independent advice. If
Yes.
not from us, take it from someone else. Doesn't matter, but take independent advice. So that's half of kind of what we're doing, and the other half is with borrowers who have lenders with these other banks who can't provide hedging or debt funds. And what that looks like is it typically takes around up to 3, sometimes even 4 weeks to go through all the KYC, AML, and also the regulatory documentation process, which we will hold their hand through. But it would still take up to 3 to 4 weeks sometimes to execute one of these caps because of the regulatory nature of it and how busy these providers are.
Yes. Yeah. I think that, in terms of arranging corporate debt right is typically never terribly quick anyway. So 3 to 4 weeks is part
Yeah,
of a concurrent process is actually really good.
yeah,
That's super useful. Thanks, Abhishek. And I guess just as given your experience in this part of the sector, have you got any kind of thoughts or sound bites that would be useful for people to kind of consider in the environment we're in at the moment? I'm reading articles all the time in the financial press around where certain people or economists think that base rate is going to go to. So
yeah.
be
I mean, look, I famously don't give predictions on where I think interest rates are going to go because, and I don't mean to sound arrogant when saying
no,
this,
no.
but I believe I'm smart enough to know that I don't know where rates are going to go.
Mhm.
I worked with some of the smartest economists in the country when I was at the Treasury, and I got the highest first class economics, from Durham Economics. And I know that economists are useless at trying to predict future rates. So there are lots and lots of column inches given to base rates are going to be this in 3 months and this in 6 months and 9 months. Great, you guys crack on and you keep having all those predictions. No one knows where these things are going to go. There's a lovely article in the FT this morning criticizing the Chancellor Rishi Sunak for not hedging last year. And they're saying actually that's going to cost the UK taxpayer £11 billion,
Yes.
more than what Gordon Brown got hit for selling the gold early. Right? And most people won't even look at that article or understand it because they'll just pass by. So no one has that crystal ball. But what you can control is what level of insurance do you put in your business at certain points in time. And we speak to some quite large businesses and REITs who've got debt of 100, 200 million, 300 million, and they are smart enough to know that they don't know where rates are going to go, but they know that they shouldn't be leaving 100% of their borrowing completely floating or unhedged at
Yes.
any point in time.
Yes.
Just like you won't have a big building and completely think, oh, I'm not just going to insure it against fire. Now, what kind of policy you use is up to you. Now, you may choose to do 25% hedging, 50% hedging. You may choose a cap, you may choose a swap, you may do 10 years, 5 years. There's lots of different variables, but it's always worth considering some level of prudent protection, regardless of where the market is.
Yeah. Yeah. Fantastic. Abhishek, that's really, really useful. Thank you so much for your time. I think we covered all the points that we were going to talk through. So certainly for our clients and indeed contacts and introducers, this is going to be really powerful as a point of consideration for them kind of moving forward.
Sure, no problem. Thanks a lot, Scott.